Hello everybody! Welcome to the Pieverse. My name's Perry. I'm going to be your host today on a very exciting, I think this is going to be one of my crown jewel videos because I really think this is going to hit the nail on the head with both the income investors, the high yield income investors that want further assurance that they are using the right portfolio and the right strategy during as they approach or are in their fire or retire stage, versus those that are on the growth portfolio side, either sitting there and saying, you know what, I'm getting close to being fire or retire with my strategy or with my portfolio, and I'm going into that stage where I want to do so. I actually want to start consuming my income and my wealth. And should I stick with a growth portfolio, or should I move over to a high yield income portfolio? So this video is going to be a deep dive. It's going to be nuts and bolts. It's going to be spreadsheets. You got to watch this video if you're on either side of this, because it will answer real, actual facts that we're going to compare the two sides head to head. So again, my name's Perry. I'm very excited about this one. This video is actually a follow-up of a video that I did a week and a half ago, which it was a much smaller, much more focused video. I didn't anticipate it was even going to be as popular as it was, and it turned out to be my most popular video in the last couple of months, far exceeding my average. So there's definitely a lot of interest in this. Again, so you're looking here right beside me on the title, it shows an ATM and it shows a lottery ticket, and it's basically comparing the income portfolio to a growth portfolio. And that is one that basically gets its monthly cash from ETF payments versus one that has to sell unrealized NAV to switch to cash. And of course, the timing of when you do that, because when you're selling unrealized NAV, you got to make sure you want to sell it at a high, not at a low. So that's why the ATM versus the lottery ticket. What's going to be really exciting about this is in the previous video, I only focused on two rock stars. YieldMax's HOOY, which is the Robinhood's ETF, cover call ETF from YieldMax, and HOOD. So I was comparing the underlying HOOD to HOOY, which is the cover call ETF from YieldMax. In that one, it showed quite clearly that HOOY was the winner when you're going through the consumption stage of your life. You're retired and you are not contributing anymore to your portfolio, and so you're now consuming, and it showed great results. But I got a lot of comments and questions and say, oh yeah, okay, Perry, you picked two rock stars. Why don't you pick something like one that's known to erode, like CONY? And another one said, why don't you pick someone average, like somebody like a conservative cover call, like for example, HYLD from Hamilton, which only has like a 14 or 12% yield. But you know, how would it do against its underlying or something similar to its underlying? So I thought to myself, okay, let's do that. I'm actually curious to see how these would all win or lose in a head-to-head battle. So you see here on the list, you see that I'm going to give you, and I basically totally overhauled and expanded my spreadsheet. So we're going to be doing a deep dive spreadsheet analysis of using real data from the past 2 years of each one of these in that case. And I'm going to do a battle between HOOY and HOOD, which we did in the other video, but I'm going to do it again to show you the rock star. I'm calling him the rock star example. Then the next one I'm going to do is called the NAV Eroder. So currently CONY has been having a bad year. It's been eroding for all of 2025. So I wanted to turn around and say, okay, so if those people that are on the growth side say, yeah, compare COIN, which is doing really good, to CONY, which has actually been eroding down to about $6 or $5 or whatever it is. You know, I personally have lost 67% NAV. So let's actually have those compete with each other and see during consumption stage what happens when these two go head to head. Who's the better winner on that one? And then on the third one, I'm calling him Steady Eddie. This is going to be the one where I'm going to actually use HYLD, which is a very conservative, very modest, I think it's 14%. Correct me if I'm wrong, 12 or 14% yielder. But he's very steady. He grows very slowly. And I'm going to compare it to, he doesn't use VSP, but he's very close to using VSP, which is basically Vanguard's unhedged S&P. So HYLD is sort of considered to be an unhedged, sort of similar to HYL or to S&P. So I'm going to be comparing VSP to HYLD. So this is going to be exciting stuff. Again, please stick around. I am a large talker. I'm going to put chapters in this, because if some people says, okay, Perry, I had enough of you talking in this one, you could switch to the next chapter. So I'm going to include chapters. If you really are bored by me, press the fast forward, go to 1.5 times on YouTube. That'll help. But if you really want to listen, then just stick around. Okay, so here we go. Let's get started. First thing I got to say is my warnings and stuff like that. And basically, I am not a licensed nor trained financial investment or tax expert. I'm just a retail investor with a passion for investing, sharing my experiences along the way on my own investing journey. Viewers must not take any content, thoughts, opinions in this video as financial advice. Do your own research and consider professional advice before investing. This content is for fun and entertainment only, so I hope you're either going to be educated, or if nothing else, you're going to be entertained. All right, so let's go quickly with what we're going to be going through. I'm going to go through an agenda. This is going to be a very complex for me. I've never had to do so much flipping and flopping between my screens before, so forgive me if I make a few mistakes. So we're going to start with the agenda. We're going to do an introduction to talk about what we're doing. We're going to do the first comparison we're going to go against is the Rockstar, which is HOOY, versus its underlying HOOD. We're going to do a spreadsheet analysis, a deep dive. So we're really going to go through a lot of spreadsheet examples and scenarios. And then after that, we're going to go from there back to here and do basically a conclusion or a summary of what we saw between HOOY and HOOD. And that's what this one is. After we do that, we're going to do the next one, which I call the NAV Eroder, which is CONY and its battle against COIN. How does CONY actually fare against its underlying coin when it comes to the consumption of income in your fire or retire stage? And then the next one, we're going to be talking about the Steady Eddy, and that's going to be HYLD versus VSP. And we're going to, again, do the spreadsheet analysis. We're going to go through the same scenarios, which each one of them, I've got a bunch of scenarios set up, and I'm going to go through that with each one of them and then have a conclusion for each one of them. And then we're going to follow it up with a final conclusions and assessments of what the whole video is all about. Okay, so let's get going. We're going to start with the introduction. So you've seen this picture before, but here's what we're really going to talk about, and this is why you should be sticking around. So assume you've been accumulated in the accumulation phase of your investment, your entire investment life, but now you believe you're reaching, or maybe you've already reached the FIRE, which for those people that don't know what FIRE is financial independence, retire early. So you feel you've built up enough wealth in your investment portfolio at age 40 or 45 that you feel you can now potentially retire, quit your job, and basically have your investments be your sole source of income. Therefore, you're going to be switching from what's called an accumulations phase and into a consumption phase. And when you're in a consumption phase, basically you have no more employment income that can contribute to your portfolio. Now your portfolio is going to be working for you. Okay, so this is what we're talking about here. Sorry, I talked about it in advance. But again, so you're switching from you serving your portfolio in the accumulation where you're contributing to it and trying to grow your wealth and grow your portfolio so that you can get to the stage of retire and FIRE. And that's where basically now your portfolio serves you and it pays you monthly. It is your source of income. You won't be generally getting income from any other source. Then therefore it needs to be self-sufficient. It needs to be self-funding, and it needs to pay you every month without going to zero before you die. All right. So regardless if you are a growth or an income investor, you must know which strategy is the most effective to serve your fire or retire income years. So again, even if you're a growth investor, and I assume many of you watching this are growth investors, there's nothing wrong with that. Absolutely nothing wrong with it. But when you switch over from being accumulation to consumption, you need to rethink your entire portfolio. And again, some of you can make the growth portfolio work. And then somebody says, look, I don't believe in these covered calls. I don't believe in the income portfolios at all. So I don't even know why you're watching this video if you're doing that. Okay. But if you're one of those people who say, you know what, Perry? Yeah, I've heard that the income portfolio is more effective in providing me consistent monthly income. It's more sustainable, but I want to see evidence. I want to see real proof. Well, this video is going to give you that proof, or it's going to give you a lot of evidence for you to rethink and decide if you're a growth investor, is it time that you should be converting over to an income strategy and an income portfolio? And if you are, at what pace and stuff like that? Or is the evidence that I provide you not even going to provide you that kind of thing? You say, yeah, Perry, you know what? I watched everything you said. I'm going to stick with my growth portfolio. Even when I'm retired, I'll just erode it down and I'll just use the meltdown strategies that my advisor tells me to do. Again, nothing wrong with that either. But either way, this video I'm hoping is going to help you make that decision or provide you more information to understand the difference between a high yield covered call ETF income portfolio versus a growth portfolio. Oop. So that's what we're going to do. I said we're going to use 3 different examples, the Rockstar, the NAV Eroder, and the Steady Eddie, so that you can have an understanding of, let's see what it works like in every one of the scenarios where you've got a covered call that's kicking butt. You've got a covered call that's been eroding, and it's like, what happens if I got one of these dogs and he's eroding? Is this exactly what I should be worried about? And then you got one of the ones is that, like, I was always a conservative person. I'm going to buy someone like an HYLD or an HDIV or, any one of the others. I'm picking on Hamilton, but several others that do nice, steady, stable NAV, stable low yielders like 10, 15%. Let's see what they all do. And we're going to pit them against their underlyings. Okay, and then we're going to have final conclusions to look at all 3 of the results at the end. And stick around for that, because I actually summarize it all and actually show you the pros and cons on basically the 2 portfolios and strategies. All right, so let's get started. Here comes the first one. Okay, so I just had to switch over here myself. So again, I spent about 3-4 days working on these spreadsheets. This spreadsheet, for those that watched my video, and it's right down here, you can see this video here. That's what it looked like. I released it about a week ago. It's actually a rock star. I have over 12,000 views, and for my channel, that's a lot. So if you haven't seen this one again, and you want to see a full analysis just of this one, I'm going to stick around. It'll be right here. I'm going to actually show you the link here. Beep, beep, beep. Up there somewhere. Okay. So you can click that and you can watch it if you want. If you don't want to, this is going to basically be a repeat, but I've added a lot more data that video never had. So here we go. Under all 3 scenarios, I've got HOOY versus HOOD, CONY versus COIN, and I've got HLD versus VSP. Under all 3 scenarios, I'm going to go through various situations that we're going to incur so they all look the same. Okay? So the first thing I want to tell everybody is this spreadsheet has been calculated so I could plug in any initial investment. But let's make the assumption that your portfolio only holds either HOOY or HOOD. I know that's a hypothetical. People are like, well, Perry, you would never just hold a portfolio with one ETF in it or one stock in it. But in order to compete these 2 head to head, the assumption is that your portfolio only has one of this or only one of those. I'm going to use an investment number of $50,000. I could put anything I want, but 50,000 is the number I've decided on. If anybody, I plan on maybe eventually releasing this spreadsheet to a future members only group in my channel, but right now that's not going to be available. But if somebody in the future wants this spreadsheet, they can do it, and then they can turn around and say, oh, I want to try 100,000. Okay. And then so my whole spreadsheet will work that out for that, but we're going to stick at 50,000. Okay. So some of the things you want to know, and we're going to do it on all three. First of all, I've got this one here, which is basically the monthly withdrawal number. So this is how much we're going to ask both HOOY and HYLD to provide me with monthly income, monthly withdrawals. So it's either zero. I'm going to use four different scenarios. One is zero, which is basically you're sitting in a non-contributing flat accumulation phase. In other words, you're not touching your portfolio. You're not taking money out of it. You're not contributing it to it. So we're going to talk about these numbers in that stage, which is what it is right now. You can see that in this stage, it says the withdrawal rate is 0%. The next one we're going to use is going to be called the growth 4% rule scenario. This is a very, very popular rule that's been, infinitum used by the growth community, growth portfolio community that is always flung around saying, hey, if you're going to be consuming your growth portfolio, you should use the 4% rule, which basically says you should be able to safely or try to stick to 4% withdrawals of your entire portfolio a year. Okay. My spreadsheet calculates what this number is and says, well, what is 4% of this? So it says it's 2,000, and it says, okay, well, if it's 2,000, that means you're going to be removing $167 a month from this portfolio. In other words, from either HOOY or HYLD. So we're going to use that scenario as our number two. Our third scenario, and again, this is basically an income investor. That's basic. When I do my calculations, I'm saying how much can each one of my ETFs tolerate in withdrawals versus reinvestments. So I have a number which basically each one of them have been calculated at that says how much can I remove out of HOOY and still have a stable NAV. So in other words, when I say stable, it means that I'm not withdrawing so much that I actually have to sell units of my covered calls. Or I haven't gone so high that I've basically by the end of the period, I've already gone below my 50% NAV or $50,000 NAV. So what I did is I calculated that out. And for HOOY, that number is that I can safely withdraw $2,900 a month from HOOY. I will be using that number, and then I will be asking HYLD side by side, how does it tolerate and how is it sustainable if HOOY, which can do it, how does HYLD survive that? Okay. The last thing I'm going to do is I do have this thing called a cash wedge. I'm not using it. I used it in my old one, but I'm just going to leave it alone right now. But the next scenario or the last scenario is I'm going to keep it at the maximum HOOY withdrawal rate. And I'm going to say, but the market's crashed over the last 6 months of the period, of the entire period, for a market collapse of, say, 10%, 20%. I'm going to be using arbitrarily that we're going to assume that the markets, the global markets crashed about 20%, which is a pretty significant crash. Okay, that's what we're going to use. All right, so here we go. So, and I'm going to talk further about other metrics afterwards. So the first number we have here is the $50,000, no monthly withdrawals. And here's HOOY versus HYLD. You could see now what I have for this one is I'm actually, because HOOY is only 6 months old, I have 6 months of actual data. So these are actual prices of HOOY on the 15th of every month. So for all my spreadsheets, I'm always going to just use the 15th of every month. If I would have done every day of the month, it would have been too big of a spreadsheet. I'm trying to keep it more conceptual. So my spreadsheets are only going to use the price of the 15th of every month. So for May, June, July, August, September, and October, this was the actual price of HOOY for the last 6 months because that's how long HOOY's existed. Okay. Now, because I don't know what the other 6 months are, I looked at these and said, okay, they're going up and down, 57, 64, 72, 71, 61. So what I did is I said, okay, let's just keep it arbitrary. I took these 6 months here, I copied and pasted, and just said, okay, it looks like it's in a trading box. I'm even going to give the growth investors the benefit of the doubt and the advantage. I'm good because we have never seen 57 come back in a long time. But I'm going to pretend that over the next 6 months, November through April, it did the exact same thing. So I'm back down here at $57 again, 64. I did that. Okay. Switching over to the other thing is the distribution. This is the other critical data that came actually out of real data. And these were the actual distributions that HOOY paid out on May, June, July, September, and October. And similar to what I did with price, all I did, because I don't know what the next 6 months are like, I took this, copy pasted, and assumed it did the same thing, including a really low 330 on 3 times. So it basically is doing a very fair evaluation of the kind of distributions that HOOY is going up and down, up and down. All the other numbers are projected, so are calculated, so don't worry about that right now. Switching over to HOOD. In HOOD, these are all the actual numbers of HOOD for the entire time. So this is from May all the way till April. Okay? So we use those numbers here. Oh, sorry, no. So my brain's off. So we did the actual 6 months here. And then I noticed that it's quite clear that HOOD is actually going up quite significantly. 60, 99, 114, 130. It's a rock star. So what I actually did is okay, let's try to extrapolate that and say for the next 6 months, it's going to have some ups and downs. We're going to have some market crashes, little dips and doodles. But at the end of the day, I said by the end of April, it could be up to as high as 150. So I basically used some arbitrary numbers, but I made it go up higher and higher until it reached 150. Okay? Again, nobody knows what the numbers are, but in this case, that's all I could do. All right? And so that's where it is. So what we see here is on HOOY, the way it works is basically it says, okay, so how many shares or units do you have initially? So considering we said that the initial invest is $50,000 and knowing that the initial price at that time was $57.16, we were able to buy 875 units at the initial buy-in. For HOOD, same scenario, $50,000 at $60.68 means we were able to buy an initial lot of 824 shares. Okay? And now we're assuming there's no more contributions coming from external sources. If you are going to be buying more shares, HOOD or HOOY has to do it from its own income, internal self-funded income. Well, we know for sure HOOD can't do that because it has no distributions. I don't know if it has a dividend. If it is, it's so small, it's not even worth putting on this spreadsheet. But let's just assume HOOD has zero distribution or dividends. And I think it doesn't. But anyways, it would be so small, it wouldn't matter. But anyways, so basically you can see here that it's going to basically say that income capitalized or income withdrawn. We're going to go through all that. So since nothing is changing, we've not asked to withdraw anything. So what we're going to say is, okay, so with the scenario of HOOY, every month HOOY is paying a distribution. So it went here, it paid a distribution of $3.30. It basically had an income generated of $2,890. Since we aren't withdrawing any income, basically all the money that was generated out of distributions can be used to reinvest back in. So we basically said, okay, so at $57.16, we bought 51 shares, and the 51 shares basically goes over under here and says 875 plus 51, I now have 925. And this basically goes all the way down till it hits the bottom. I also added in this spreadsheet versus the old video that I did, I showed growth, income, and total ROI in both how much of it's per share. This is a per share or per unit ROI. So in this one here, the growth obviously was zero because it's at the initial price. It did grow by $3.30. So basically it has a total dollar ROI of $3.30. So it's showing a 6% ROI. Okay. On the HOOD side, it's $60.68. You got 824 shares, $50,000 investment. Since there was no withdrawals, you didn't have to sell any shares, but you obviously had no excess income because HOOD doesn't generate any distributions. So basically the ROI on day one, on the first month, is zero. Okay. So we move on to the second month, same thing happens. Now it has 925 shares. It's obviously increased because not only did the share price go up, but I also have more units held. So my NAV here went up to 59,000. It had a $6.50 distribution. Income generated was 6,000. It used all that. to rebuy another 94. So not only did it have a $7 growth, but it also had a $9.81 a total income generated. That's the 330 plus the 650. So now it has a total ROI of 1681 or 29%. On Hood side, its price went up $16. So that's really good. So even though it has no income, it also went up $16 and it had a 26% ROI. And you can see this goes on and on and on all the way to the point where we're down to here. So this is 1 year of scenario. At the end of the year, basically, HOOY ended up with 2,070 shares. It was over its $50,000 unrealized NAV of to 149,000. So basically, it grew $99,730 in 1 year, or basically a NAV gain of 199%. On Hood side, it also had a really good scenario. It went all the way to $150. It grew at 147%. And again, these are arbitrary numbers because like I said, we don't know what the last 6 months, but using these numbers, it had a $73,000 increase or 147. Again, arbitrary numbers, but basically it's showing that in both scenarios, Hood and HOOY had some great gains. But HOOY had even better gains because not only did it have a subtle increase in its share price on the last day, it also increased the number of shares it owns right here. It added 1,195 extra shares. So it's not only this, but it's this plus its total number of shares from 875 all the way to 2,000. So it basically grew more so because of its number of shares at that price than the share price alone. In the case of Hood, it basically grew simply because it didn't gain any more shares, because in a growth portfolio during consumption, you can't buy any shares because you have no money to contribute. So basically it grew purely based on the growth of the stock price itself. So this is pure unrealized NAV from growth price. Okay. Under this scenario here, I don't show this here, but under this scenario, obviously you're not going to erode to nothing, because I've also gave the assumption on an annual price gain because I didn't want to go through all 12, 13, 14 years. So what I did is I basically said for the growth portfolio, I'm going to assume a 10% growth in the stock price every year. So in here it was 150. So we assumed it's going to be 165, then 182, then 200, 220. So by the end of the 13th year, it's almost at $500 a share. So I picked 10%. You guys can argue, no, Hood's going to be 15% or 20. I picked 10%. That is the arbitrary number, and that's the number I'm using. And this is going to show the NAV meltdown pace. But of course, with no withdrawals, there's no meltdown. You can see here the price chart difference. Obviously, Hood did much better in its price appreciation. The underlying definitely outgrew the ETF at 72 versus 150. No question there. But the part that never gets talked about, even though this guy had a better ROI, this guy wins because it actually grew by sheer number of extra shares that it was able to buy that Hood could not buy. So the people that says ROI or return on investment is everything, well, return on investment is great on a per share basis. But if I have 2,000 more shares, even though I have a lower ROI, I have 2,000 more shares. So I am growing in sheer volume of number of shares, even if it's at a lower ROI. So my NAV is greater, even though this guy's ROI is higher. And that's because he's only an ROI on 824 shares versus this guy's 2,070 units that it grew from 875 because it actually capitalized income and reinvested. The other thing that's going to be used here, and I'm going to use it only here, which is very important, is the fact that there's house money involved. So unlike here, you'll never reach house money status because unless you basically sell your shares to reach it. But in the case of HOOY, it reached house status, and I'll show you where it reached house status. What house status means is that it basically has received enough monthly distributions that it's already paid off its initial investment of $50,000. So we're going to try finding that number. So I'm going to say, let's say it's about here. Okay, so I'm going to close it. And it said, nope, close. So let me just do it again. And it says, oh, okay. So basically, an interesting fact, in January, which is, I think, 9 months, 1, 2, 3, 4, 5, 6, 7, 8, 9 months. In 9 months, HOOY has already received more distributions than it actually you paid for it. So it is basically in house money by the 9th month. So anything or any income that's being generated after January for HOOY is now money. It's house money. It's money that's already been bought and paid for, and it's all, call it free cash coming your way because it's already paid for itself. So that's an important number. January, the 9th month, HOOY already paid for all of its investments. Okay, so now we're talking about the next scenario where we're going to turn around and say, this is where things get more interesting. Now we're going to use growth's 4% rule and says, so how does HOOD versus HOOY live on 4% rule? So we know the 4% rule for $50,000 is $167. So $167, there you can see there's the 4% rule. Now basically you can see that $167 is being asked for from the portfolio into my bank account every month, and HOOD and HOOY both have to oblige. So with the case with HOOY, that's easy. Since it generates $2,890 every month, paying me $167 is nothing. I still got $2,723 left. So I can now still go out and buy 48 more units and 91 and 94 and on at those given prices. So I'm basically gone up. I basically was able to collect my $2,004 and reinvest all my money into this one. Okay, so that's in here. I basically didn't see, even though I had $2,004 gone, you could see that my income is or my unrealized NAV is $96,000. It's still gone there. It's at 193% versus, remember, it used to be 199%. So that little portion was taken out of it, and there you go. On the growth side, again, you're starting at 824. Now it's up to HOOD to actually start selling its shares. Since it doesn't generate any income, it has to do it by eroding itself. So it has to say, okay, Perry wants $167. I got 824 shares at the current price of $60.68. I have to sell 3 of my shares. And there you go. There's your capitalized income. And then it draws down 167. No excess income because I sold enough shares just to pay the bills. And of course, I didn't buy any shares because there's no shares to contribute. So you can see this is going to happen on both cases. It basically says, oh, okay, he now wants it again. And these numbers are going to change depending on the price. Obviously, when you get down to get up to $150, well, I only needed $167, so I only had to sell just 1 share in order to get it. So the good part about a growth strategy is if the NAV is increasing in value every month or every quarter, the amount of shares you have to sell is lower. That's good news for a growth portfolio when you're in the consumption stage. You could see that nothing changed on the ROI per share, because at the end of the day, that all stays the same. But the big difference is here now that after 1 year, HOOD has lost 18 of its shares. So when you now turn around and say, okay, so it lost 2% of its shares, it's now at 142. Now, if you look at it and says, okay, so what does that mean? What does that mean for my NAV over the next 13 years? Well, obviously, if you're following the 4% rule, and that's why I guess why growth investors use the 4% rule, it basically says you're safely withdrawing enough money that you're actually withdrawing less than you are growing, and therefore you should be safe. And that is pretty much what I'm seeing here. You're actually seeing it go up. It's up to 136,000 by the 13th year. So it's not going down. It's literally going up because we're assuming a 10% growth in the stock every year. So obviously you're getting up to 336,000. Great news for HOOD. Okay. HOOY, it's not going up that much, but again, remember, it's an income portfolio. So its job is just to provide the income needed to pay my bills and then use the excess money to make sure that it stays stabilized or even grows, but it doesn't have to keep up to HOOD, which is what a lot of the growth investors keep saying is, well, it's underperforming. It's not underperforming. It's performing at the level that an income investor wants. An income investor right now is asking for 167. It has more than enough to do it. So not only can it pay its bills, but it also has so much excess income, I can actually grow my portfolio, not even keep it stable, but actually grow it and pay the bills that I need. So that's why I say these people that say that it's a horse race between growth and income, it's not. It's a race between how much I need and how much the portfolio can give. And right now, HOOY doesn't look at HOOD and say, oh, look at HOOD's way up at 336,000. You know what? Well, that's fine and dandy. It doesn't matter. At the end of the day, I only asked for $167. But things are going to change now. So now we're going to say, okay, fine. Now let's go to a point where he says, okay, so now HOOD, here's HOOY. HOOY is a rock star. HOOY generates so much money that it can stably, without reducing, without damaging its NAV, and without having to sell units in order to do it, I can actually sustain a $2,900 a month withdrawal from HOOY. And that's what I'm going to do. And let's see how HOOD can keep up to me when I'm actually asking HOOY to do what it can do stably. And that is $2,900 a month. Okay, I am now, and I know this will blow the doors off of growth investors that are hoping that they can get 4 or 5% income out of their growth portfolio. This $50,000 portfolio is now going to give me a withdrawal rate of 70%. And I know that drops jaws. At 70%, which is really pushing the envelope for HOOY, but it's still okay. You can see that under no situation throughout the year did HOOY ever have to sell any units to do it. It basically was still growing, even though it was at 2,900, because during it there, it was saying, oh, well, I have $5,600 left. You asked for 2,900. I still got excess income. So I'm still able to buy 43 shares. And so it's still growing because in addition to the 2,900, it still has money to actually reinvest, and it keeps on doing it. So even though it's at $2,900, it still realized a NAV growth over the year of $41,980. Okay, again, look at here. Nothing has changed on the prices. The situation hasn't changed. What has changed is that the income investor has now said, hey, I want more from you than $167. I know you can produce it income portfolio, so give me $2,900. Now, if I ask the growth portfolio to do the same thing, let's take a look at that. So here's the growth portfolio. Nothing's changed on price. Started at 824, but now you're asking the HOOD portfolio to give me $2,900. And now the growth portfolio says, well, I have to sell 48 shares to do that. I'm not got any excess income. So nothing changes there. Nothing changes in our ROI. You can see that, again, at the end of the day, they say ROI is everything. Well, here it is. I'm still at 147% ROI versus 133. HOOD still has the better number, but let's watch what happens with me asking to pay $2,900. So it does it again and again and again and again. Every month, HOOD is being asked to sell shares so that you can make your $2,900. By the end of a year, basically, it started at 824 shares, and now you, at the end of the first year, you've already had to liquidate 320 shares of your 824 shares. In other words, you've lost 39% of your actual shares. And a share that sold has zero ROI. Let's say that again, people. A share that is sold has zero ROI. It no longer gives you unrealized growth, and it no longer gives you any more capitalized income. You've spent it, you've capitalized it, it no longer exists on your books. So the only thing that's left on your books is what you have not sold and have not realized. So this 147 honestly doesn't mean too much when you are actually asking it to consume $2,900 a month. What it says here, even with a 10% increase in HOOD's share price, that by the fourth year, you will no longer have any HOOD left. No HOOD shares will be left after the fourth year, while on the other side, HOOY is having no problems. It can do this another second year, third year, fourth year, fifth year. It could keep going. And even though it has market ups and downs, it will still be able to do this. So this is the situation which shows why a growth portfolio cannot keep up with an income portfolio during consumption, because there's no way in a growth portfolio of the same size as an income portfolio that it could keep up on the same income level, maximum income levels. So the only way HOOD has to be able to survive is to actually follow something closer to the 4% rule and says, oh, okay, it's going to erode this fast. I'm going to have to, maybe I can get away with 8%, 9% because HOOD is growing so fast. But there's no way that HOOD will ever be able to keep up with HOOY on an income withdrawal rate of $2,900. And again, HOOY has no problems doing it. HOOD is collapsed by the 4th year. Okay? This is what I'm trying to say. Nothing has changed. Still 147% ROI. Yeah, you beat me. 133, 147. But if that's the case, during my consumption phase, why did I run out of all my holdings by the 4th year? Because it can't keep up to an income portfolio when you want to ask for the maximum amount of yield and distributions at the same portfolio size. So now let's do one more scenario, and that is basically, let's assume that we had a market correction for the last 6 months of this period. So basically what I'm saying is, in the last 6 months, this went down 20%, this went down 20%, and basically what I did is, because I've noticed from the Liberation Day, I noticed that basically the amount the markets went down for these ultra yielders, they also went down in distributions about the same amount. So what I did here is I said, okay, during the same 6 month period, drop all my distributions by the same 20%. So that basically I'm not getting 650. So now watch this. I'm going to say, assume a 20% market drop. So now I'm only getting $2.64. I'm only getting $5.20 when I was getting $6.50. These numbers all went down. I'm not getting as much income because of the market correction. Obviously, my prices also dropped. So now I'm down at these prices, $45.57. On the side over here with HOOD, there's no distribution to withdrawal because, of course, it doesn't do that. But it did drop its NAV. Its NAV on its prices now dropped 20%, just like the other side did. So now we're down at 120. So you could see that basically, now that the price is down here, basically my NAV by the end of the 2nd year and into the 3rd year, because I have a 6 month, and it could keep going, it could go 6, 8, 10 months, I'm basically depleted of HOOD by the 3rd year. I might last another year, maybe 2, but at the end of the day, generally, even if it comes with a 10% increase after that, you're gonna be depleted by the 2nd year. Even if HOOD has a miracle increase and it goes back up, again, you're only gonna get maybe another year before you'll be fully depleted. So don't use the argument as, oh yeah, Perry, but you're using the wrong numbers. Okay, fine. Here's 15%. There, okay. Oh, you want to go? Okay, let's have it. It had a miracle 20% per year. Look what's happening. At the end of the day, HOOD cannot survive much longer than 3 or 4 years. Let's even assume it's some crazy, say, 25%. In other words, the shares are basically now at $1,700 a share. Okay, if you're doing that, then you better buy a lotto ticket for sure. You're still not getting to the 4th year, even with a 25% gain per year. Okay? So we're sticking with 10. All right. So that's where our scenario is. I'm going to go now back and summarize. Okay. So here was the summary for the Rockstar environment. So using the 0 monthly withdrawal, even though HOOD has a higher per share ROI, HOOY has the higher NAV. And again, we said that because this is due to HOOY's massive reinvesting, which HOOD just simply can't do because it has no sources to contribute extra cash to. So basically, HOOD sits there while HOOY builds up its arsenal of extra units. The other thing we noticed here is that during the first 9 months, HOOY has already established house status, and anything after the 9th month for HOOY is basically gravy. It's money that's bonus beyond the $50,000 that we've already realized, and it's still delivering. We did use the 4% rule, which growth investors use all the time. And in there, not much changed because the number was so small. HOOY still is the NAV winner in this one, even though under all scenarios, HOOD is going to always win the ROI battle. But again, I care more about NAV if I were a HOOD user, because as a growth investor, because at the end of the day, you're paying your monthly withdrawals from the NAV as much as you are paying it from the ROI. Okay? And not the only thing that we will give credit to the growth investor is that because it's only using $167 a month, the good news is that HOOD under this scenario, or if you're only asking it to pay to withdraw $167, the great news is HOOD will last you for a lifetime. Again, lifetime, we don't know what's going to happen with the global markets in 20, 30 years, but assuming generally the same conditions, you know that basically HOOD will exist at $167. Now, using HOOY's maximum $2,900 stable monthly withdrawal, what we noticed there is that HOOY's NAV was still rising, even at $2,900 or 70% withdrawal rate, without selling any units, and sustained its maximum monthly withdrawals. At the same time, HOOD's NAV fully melted down by the fourth year. You had no HOOD left at the fourth year. Applying the 6-month 20% bear market, we saw the following. Even with HOOY's 20% decline in monthly income, we did still sustain the maximum monthly withdrawal. We didn't have to reduce it. It basically was able to still have excess distributions. And again, a lot of that's due to the fact that it happened when we already built up a lot of extra units from all the redistributions, the reinvestments over the months. So basically, it had more than enough money, even with a 20% bear market. So this goes to the argument that says, oh, during a bear market, that's when covered calls are going to go crashing. Well, first of all, you don't know that. I don't know that. But I do know one fact. During the pandemic and during the Liberation Day earlier this year, in both scenarios, the covered call ETFs that existed then and this year all fully recovered and actually went higher. And they all did still pay their distributions, even if during the period of the decline, they went down equal to the market decline. So it still paid, even though it paid less, it still paid. So that is the facts, and you can't use these scenarios that, well, what happens if it's going to be 2008? Nobody knows that. You don't know that. I don't know that. But I do know the facts, and I do know what happened in the pandemic, and I do know what happened in the Liberation Day. And in both scenarios, the covered call ETFs fully recovered and actually went higher than that. Okay, and HOOD's NAV fully depleted in its third year, so it actually depleted a year earlier because of the 6-month bear market. So who's the winner in this scenario? Hands down, HOOY beats HOOD, the underlying, in all situations. There's no question about that. So what would I do if it's Perry? So what would Perry do in this battle? Okay, well, if I were an income HOOY investor, which I am, I own that actual ETF, I don't change anything. Everything was working exactly as planned. What I might consider doing is using some of the excess money to reinvest in other covered call ETF holdings to further diversify. So again, I don't have to drip right back in. I can actually use some of my excess income and say, you know what, I'm going to give some to CONY, or I'm going to give some to HYLD, or I'm going to give some to HHIS. So I would consider using it, and I do that all the time. I don't drip. I decide every month where I reinvest, and so that's what I do. That's why I put that in here. If I were a growth HOOD investor, what would I do? Well, I would take the opportune market timing when the markets are really high, and I would start selling HOOD and buy some HOOY or even any other covered call ETFs to diversify. If you are a fire or retire investor and you are not contributing anymore to your portfolio, and you're asking of money to come out of your portfolio, you're now dissolving your wealth or drawing wealth out of your portfolio, I don't understand why you would be sitting on HOOD if you could quite clearly see here that taking that money and moving it into something like HOOY might be your better approach. Alternatively, if you're a die-hard growth investor and you don't believe in covered call ETFs and you don't believe in high yield income, hey, more power to you. Stick to your 4% rule. Play it safe. Basically, only withdraw the $2,000 a year or $167 a month or whatever 5%. Maybe you want to use 8%. If you're happy with that, then hey, more power to you. Just accept the fact that HOOD will not be able to sustain a much higher monthly withdrawal that HOOY can easily do. So you decide which one you want to use. All right. Now we're going to go to the second scenario, which is the one that I'm sure a lot of growth investors are interested in. And that is the scenario. Let me get over here. CONY versus COIN. Again, a lot of people have known what's been going on. If you haven't known, I'm picking CONY. I actually own CONY. My CONY basically is down 67%. I've held it for pretty much the entire time. This spreadsheet is now using a full 26 months of actual data. So unlike the first spreadsheet, you're looking at actual data for the entire 26 months. It wasn't easy for me to collect, let me tell you. And again, please, I'm going to ask you, this was a lot of work, this video. If you haven't subscribed yet, I would really appreciate if you did, as a appreciation for all the work. If nothing else, at least like me. It would be great. But this took a lot of work, and so yeah, please press the subscribe button. Anyways, so what I did is, this is actual. Unlike HOOY, these are actual numbers for CONY. And actual for COIN, these are the actual numbers for COIN in the same scenario for the same 26 months. Everything else is the same, 50,000, 4% rule. We don't have to rechange all that. I told you that it was 2,900 before. Well, for CONY, when I did all the calculations, the maximum stable monthly withdrawal that CONY currently can tolerate is $1,900 a month. And that goes by the saying that at that level, it never had to sell any units. And at that level, it never went below its initial NAV in the first 2 years. So that's $1,900. All right, so let's get going. First thing is no withdrawals at all. This is basically what's called a non-contributing accumulation status. You basically are sitting on COIN or you're sitting on CONY, and what's the situation? In this situation, for CONY, it basically, here are all my distributions. By the time it finished the 26 months, it basically moved up from an initial investment of 50,000 to an investment of to an unrealized NAV of 107,000. So that was a $57,000 increase, or 114% improvement in the NAV. Most of that, matter of fact, all of that for the most part, has come from reinvestment. And the reason is because it started at 20. Currently, as of September, it was 724. Now, the good news about this is when you don't have any withdrawals happening and you're basically still getting distributions, like even the last one here, it was 45 cents, you're still making $6,300 because you have so many additional. Where I used to have 2,500 shares units, I now have 13,000 units now. I'm still making $6,000 a month on income because I bought so many reinvested shares, because none of it went to withdrawals. So I literally was able to buy, for example, in here, I had $6,300 to buy. So I was able to buy 870 more shares. So this went over to here. So basically that's it. Again, it all happened because of the NAV drop, which made the reinvestment numbers much higher. Now, if the NAV ever were to stop eroding, and you can see that really CONY started eroding somewhere of July 2024, and it just kept on going. We don't know what the reason is, but anyways, that's what it's been doing. We don't know if it's going to continue doing that or if YieldMax is going to fix the problem, but this is what we know so far. Okay, it currently has a total ROI of 98%, and that is basically the $12 drop in its price, but it also has a $32 income. So even though it's got a 67% NAV decline, it still generated a 98% ROI. Pretty good. Now, if you look at COIN, which is the underlying, and again, I know people are going to say, no, YieldMax doesn't use COIN, it uses a synthetic. Again, a synthetic is literally trying to replicate what COIN is. So we're going to keep things simple. COIN is their underlying, even though they use a synthetic version of it. So we're going to use COIN. COIN has been all the way up and down. You can see on the price chart here, it really flew up. Then it went down big time. Then it went up again. Then during the Liberation Day, it went down again. And it's been going up ever since. So it's been a rock star, while CONY has been dropping. So you're going to sort of say, this is the worst case scenario for an income investor. If you're a growth investor, you're sort of licking your lips and saying, okay, let's see who wins this battle. Okay, so here's the situation. 670 shares were bought here. Again, we already talked about this one, 2,500. So coin had 670. Again, it never increased any because there was no withdrawals, but there also was no income. So at the end of the day, you basically saw coin grow from 50,000 to 219,000. That's a 338% increase. And well, you know what? Totally beat CONY. CONY's NAV, unrealized NAV, is only 114%. So the growth investors are like right now pumping their fists saying, see, Barry, I told you. Look at that. If you would have done this, you would have had $338,000 or 338%. It had a 338%, obviously, ROI. All based on NAV growth because it couldn't do it through any income. This guy did it all growth on income, and actually the rest was all loss. So it still did 98 at a loss. This was all based on pure NAV growth. Okay, now let's go to the second scenario. $167 based on the gross 4% rule. Under this rule, nothing really changed. It now dropped to $105,000 because it had to pay the $4,342 over the 26-month period, not the 12-month like the last one. So really nothing's changed. CONY was able to have more than enough distributions to pay for that every time. So it still had a lot of excess income. Therefore, it was still able to buy a lot of units. And so it was still able to support itself on the number of units it bought. It bought 11,636, 465% increase in number of units, 105% increase in NAV. Over here, now coin has to start selling its shares. Again, minimal because it's only 167. So 2, 2, 2, 1, 1, 1, 1, 1, 1, 1. So really didn't do much difference. There it is. It's now down. It's now gained $160,000. Of course, what you're going to see, no NAV meltdown, because that's, of course, what the 4% rule is all about, saying that you're not withdrawing more than your underlying or than your growth stock can actually support. Therefore, there was no expectation that we would see any NAV erosion at all or erosion to zero, because this is the 4% rule for growth investors. Okay, nothing changes there. Now we're going to move to CONY's maximum stable withdrawal rate, which is $1,900. So I can safely take $1,900. It's at its maximum, but I could safely take $1,900 a month out of CONY. That is a 46% withdrawal rate. At a 46% withdrawal rate, you could see that in the first 2 months, I actually had to withdraw some. And the only reason it did that is because in the first 2 months, they YieldMax didn't pay much distributions. After they did that, they literally went up from there. So I basically considered it $1,900. I could have made it $1,800, but these are the only two. After that, it never had to buy or it never had to sell shares at all after those two. Okay. It also basically kept over the $50,000 NAV. So that's why I picked $1,900. It's still over the it's still at over the $50,000 mark, but you could see I'm really pushing this cover call ETF to its max at $1,900. It's still holding there. A lot of this drop on NAV is because of the because it cannot hand out as many units as it did before. Whereas offering 800 can now only do 175 or 66. So it's really drop the amount of reinvestment that it can do because it's all going to withdrawals. And therefore that drops how many shares I can have. And that's, so that's the biggie there. Okay. Again, nothing changes here. It's still 98% because that's a per share. Nothing changed there at all because that's still based on what the NAV price is and what the distribution was paid total. Okay. So on coin though, here's the big difference. Now you got 50,000. Now you're asking coin to pay $1,900 a month in withdrawal. So in order to do that, the growth investor now has to capitalize $1,900 of its NAV back out of its NAV into actual cash. That means it had to sell 25 shares, 24, 25, 21. Now, the good news is coin's stock price is going up and up and up. So it doesn't have to sell as many as it keeps going up in price. You know, it ends up at the end of 2 years saying that I only had to sell 6 shares in order to give you your $1,900 because the price of the stock has been going up. So that's the good news. Again, but that's the bad news about this is it's not sustainable, because at the end of the day, after 26 months, of the 670 shares that it had, 285 shares have already been lost. Those are 285 shares that are no more giving you any unrealized NAV. They don't give you any income. Those are lost and gone forever. So you now only have a NAV that's based on 385 shares. So even though you have a 338% ROI on your remaining shares, that's a per share ROI. It doesn't mean anything about the NAV, because for your entire portfolio, you might have a higher NAV or ROI, but again, similar to what we talked about in the last spreadsheet, you're now down to only 75,000 again, or 125,000. So you're up still $75,000. That's good news, but you're not up the 300. What was it on the other one? Let's go back to zero. You're not at $169,000 in NAV. You're now down to only $75,000 in NAV. Now, the other thing that makes matters worse for the growth investor is that this keeps going. So by the third, the fourth, the fifth, on the 6th year, basically you've run out of shares to sell. You now are fully melted down on coin. So when you started at 50,000, even though you had a beautiful run up of a 338% ROI, unfortunately you had to keep selling them. So by the 6th year, you no longer have any coin shares left. It no longer can pay you that $1,900 a month. Coin is now off the books. CONY, on the other hand, even though it's, you're pushing its limit, it's still going to be able to push this through. Even if it does slowly NAV erode, it's going to basically, you're just going to buy more shares from the excess. Again, the thing I assume with CONY is if they don't stop the NAV erosion, slowly but surely the distribution number is going to get smaller and smaller. It may not be 5 years, but maybe around the 8th year, you could see CONY maybe not survive, but that has to assume that CONY will continue to NAV erode. I do believe, honestly, they've done it with all the other stocks, like Defiance has done it, and the others. They eventually do fix their NAV erosion by actually addressing, the call spreads and stuff like that. But assuming they don't, I could see CONY maybe in the longer period of time might eventually run out of cash as well. In other words, it wouldn't be able to support the $1,900 anymore. That's really what it would be. And for an income investor, you would just have to turn around and say, well, we're just going to have to, reduce it or call it quits with CONY or move it over somewhere else. So, okay. Now, let's assume the worst case scenario that not only are we taking this kind of money out, but here's our 20% market decline. Well, now basically HOOD is basically depleted after the 4th year. CONY is down 10% or is down $10,000 already. So he's really starting to go down quite bad as well at that thing. But again, this is only as long as the market decline happens. It will start going back up again as soon as the markets go back up. We have seen recovery in past, like I said, the pandemic and the Liberation Day. So this will likely happen here. This would likely recover here as well. So again, I'm assuming CONY, after the 6 months is gone, it's going to go back up. And, you would get back to maybe the 5th year again or the 6th year. But at the end of the day, by 5 or 6 years, coin will not be able to survive at a $1,900 income rate. Okay? Even though it's got amazing NAV chart. It just, when the income investor is asking for so much from you, something that CONY, pushing the number, but something that CONY could survive on, coin cannot. If you even want to turn around and be more modest, you could have turned around and said, okay, fine, let's just keep it let's make it $1,000. Well, the good news is that coin could maybe survive up to the 9th or 10th year. But the good news about CONY is it now can easily survive $1,000. So again, what I'm trying to explain to the growth investor and to give confidence to the income investor is the fact that head to head, both can maybe do this, but at the end of the day, when you say you're only asking for 1,000, it's CONY that will be the investment that will last you a lot longer versus coin. Coin will be able to last some time, but sooner or later, it's going to run out of shares to sell. And that is the number one reason why a growth portfolio will not survive versus an income portfolio when you're actually trying to push your income to its max. I don't want to live at a 4% rule. I want to have a portfolio where I can allow a 24% withdrawal rate, not a 4% withdrawal rate. I can easily survive with the same $50,000 and get $1,000 on a 24% ROI or withdrawal rate that coin would not be able to survive after 10 years. Again, so that is the big difference. It's the efficiency that an income portfolio has over a growth portfolio when you're asking the portfolio to start being consumed. That is where an income portfolio wins because it has capitalized income that it can generate without selling its shares. All right, so let's go back. What we realize here. So we said with the NAV Eroder, basically, even with CONY's massive reinvestment, because of its current NAV erosion, its NAV can't compete with coin. So coin definitely wins when it comes to NAV when there is no withdrawal at all. And that's because CONY can't even keep up with it because its NAV erosion is going down, whereas coin's prices are going up. So there's no question there. So the one good news is we didn't put that. I should have calculated for you. The good news is, though, CONY reached house status after 10 months. So even though it couldn't keep up on the NAV to coin, on its 10th month, it fully recouped all its $50,000 initial investment. So after the 10th month, CONY was actually on house money status. Everything it was paying you in addition to what you already invested in it. So keep that in mind, that even if you want to try to burn CONY and max it to its $1,900 maximum, and you say, you know what, I'm gonna push this thing to the nth degree, and even if CONY dies in about five years or 6 years at that level, that's 4 years of CONY paying you $1,900 a month that was beyond the amount that you paid the $50,000 for. You can now use that money and reinvest it in many other things. So do that. You basically have seen your money reinvested, recouped at the 10th month, and 3.5, 4 years, 5 years, I don't know what it is, of extra money that was coming to you in addition to the $50,000 that you paid for it in the first place. Big, big win. This is the non-contributing accumulation phase, so clearly coin's unrealized NAV grows much faster than CONY. There was no debate about that. An underlying will generally, in most cases, beat a cover call ETF, and this was proof of that it was doing that. Using the 4% rule, we saw not much change because the number's so small. As such, with the low-income, coin would nearly never melt down to zero. We gave credit to there, saying that, yeah, generally because you're using the 4% rule for a growth investor, coin could pay that 167 infinitum. It's never going to have a trouble doing that. Using CONY's maximum stable $1,900 a month withdrawals, though, that's where the tables start changing. So CONY's NAV still is above the initial investment after 26 months without selling any units other than those couple first months. Even with CONY's slow NAV erosion, it still produces more monthly income than the max stable withdrawals, meaning it can still pay the $1,900 and still have extra money to keep putting money into reinvestment. Where on the other hand, coin's NAV still was over the initial investment after two years or 26 months, but by the 6th year, coin was fully depleted. You fully melted down coin because you sold all its shares to pay the $1,900, so it was gone on the 6th year. Applying the 6-month 20% bear market, what we noticed there that CONY's NAV was now below its initial investment during that period, but its monthly distribution still exceeded its withdrawals. So it was still able to pay, even though its withdrawals dropped by 20% or its distributions dropped by 20%, it was still able to pay its bills. Coin's NAV still was above its initial investment after two 2 years, but it actually then fully depleted on its 5th year, not its 6th year. It lost a year because of that market decline. So the winner here, even though coin was winning in NAV when there was little or no withdrawals, the winner is CONY. And again, the winner as perspective of an income investor, that is number one priority is to make sure you pay me my $1,000 or you pay me my $1,900 a month, because that is what I ask of you. That is my goal. As an income investor, CONY beats coin hands down on that one, because where coin eventually depleted in 5 or 6 years, CONY was able to keep going until rocking, even though it was an eroding cover call ETF and you know, it struggles versus some of the others. It still wins because it was able to keep going on. And again, that's why it's the winner. What would Perry do? Well, if I were an income investor of CONY, which I am, CONY was at house status. So you could just turn around and say, you know what, Perry, it's done its job. I've gotten my $50,000 on it. I'm already a year past how much I've gotten money. Let it run. Let it ride. Let it keep doing it. And yeah, it's going to keep shrinking its distributions as the cover call ETF continues to erode. If it does. If it doesn't erode and it actually solves its problems and it actually starts getting stronger, man, I'm going to do really good because I bought all those extra units, at those low prices. But even if it doesn't and it keeps going, it's still got several years of income generation that is basically house money that I never paid for. If you were a growth coin investor, what would you do? I think the scenario is going to be the same thing. You could either accept that coin can only support lower monthly withdrawals than CONY. So you could turn around and follow the 4% rule, maybe be more aggressive and say, yeah, okay, 4% is maybe a little low, but I can get safely maybe $300 or $400 a month out of it, and it'll last me at least 20, 25 years or 20 years. I don't know what the number is, but you have to accept you will never get $1,900 a month out of coin because it won't last long enough for that. So you have to just accept you have to have a lower withdrawal by selling your shares. Alternatively, and this is the one I would do, if I were a growth investor and my priority is to generate income most effectively and maximize, I would be doing the same thing I did with HOOY. I would be starting to find opportune market timings when the markets are really high and coins at a good high price, start selling some of those shares and start buying some other, cover call ETFs that have stable NAVs. I would not pick CONY right now because you can already see it's one of the few cover call ETFs that's eroding. Most are not. So you might turn around and say, I'm going to sell my coin and I'm going to buy, say, WPay, or I'm going to buy BLOX, or I'm going to buy those that have actually a really good solid NAV and also provide a great monthly distribution. So that's what I would do if I were a growth investor and I've switched over to being a consumer of my wealth. Okay, final situation. Let's go to the last guy. Okay, we're switching to what we call Steady Eddie. So this one is HYLD. It's from Hamilton. For you Americans that are watching this, this is a Canadian covered call. Very, very conservative. It's based on the S&P 500. It doesn't have the S&P, but it has a lot of the stocks that the S&P have. So a lot of people would compare HYLD to an S&P cover call ETF. And that's why I used VSP. They don't hold VSP. They hold a lot of their own that basically has similar stocks to VSP. But we're going to use VSP because it's basically both are Canadian unhedged, and both of them basically hold the same underlying. So this would be that one. HYLD doesn't hold this, but it holds very similar. A lot of people do compare VSP to HYLD when they try to do comparisons to each other. All right. Same scenario. No withdrawals. And here's the situation. 50,000 dollars bought 4,212 units. It's basically generating about 500 and there. By the way, just to tell you, all these metrics are actual figures. And all these metrics for the last 26 months are actual figures. So these are actual numbers. distributions, actual numbers from Hamilton. And of course, there are no distribution. Oh, sorry, there is. So VSP, unlike the other two, because it actually is an ETF that holds the S&P, and some S&P stocks actually have dividends, it actually every quarter pays money. So there it is, actually showing that it actually paid 21 cents a quarter, 25 cents a quarter. It's peanuts, but I still put it in there for somebody that says, Barry, VSP does pay dividends. Well, I did put it in there. There's your dividends. Okay. So in here, basically, you got your 12 cents on this one, made $500. So basically, the excess income came from here, and we move all the way to the end. But, all the way to the end. At the end of the day, after 26 months, HYLD, if it did full reinvesting and had never had to pay out any withdrawals, it went up to 81,000. So it basically had a gain, an unrealized NAV of $31,000. From initial buy-in. Okay, that's a 64% increase. Again, you're not going to see the HOOD or the CONY, the HOOY or the CONY kind of numbers. This is a very conservative cover call ETF. It only runs, I think, 12 or 14% yields. It's very conservative. It is a very stable cover call. It has a very good price increase. So it trades in a trading box between 11 and now I think what this is as of October 25th. It basically was at 1490. So it's basically very tight. It does not move much at all. Again, as an index-based cover call ETF or an index would do. So this guy is very stable on its NAV. It pays a very stable distribution. You can see, 12, 12, 12, then 12, 1, then 13, then 14.3 for several months, and then 14.5 for several months, and then 14.7. And by the way, as of today, it actually moved up to 15.3. So the good news is not only is it a very stable distribution payer, it's also slowly but surely increasing. It doesn't waver up and down like CONY or HOOY does or any of the ultra yielders. Because these cover call ETFs from Hamilton, Harvest, Evolve, they tend to be very stable on their distributions. So they don't like volatility here. Even if it's up or down a little, they'll always pay it up to here until they feel comfortable they can go higher, and then they'll go higher. If they can't support it, after a while, they'll say, okay, we can't support it, we'll go lower. So you'll see very stable numbers here. And this is an important thing to know because even when we do a market correction of 20%, I cannot drop these guys' distribution 20% because I know full well they would not do that. They have strategies where they would maybe drop it maybe half a cent, maybe a cent at the most, but very little. So I could not use that number. So when I did the calculations for market correction, I said it would only move 25% of the 20% because I know that it is actually very stable on their distributions. Okay, so we know here 31,000, it went up 31,000, 64%. VSP did very good. It again, people love VSP. It's based on the S&P. It started at $73, and you can see slowly but surely. Let's look at the price chart. The price chart shows that slowly but surely it goes up. Here was Liberation Day. You can see it had a little dip, but you can see slowly but surely it just kept on increasing. Same thing with HYLD. They both slowly but surely increased. So they both are very close to each other. But when you include the fact that HYLD, I believe, has some leverage, but it also is a very conservative with regards to its distributions. When you add that all together, HYLD, even if you aren't using it as in a consumption stage, HYLD is beating the VSP because it only has a 46% ROI based on this chart versus a 56% based on this chart. So HYLD is already winning even if you don't withdraw any money. So I think you know where we're going here. If I turn around and say I'm going to use the 4% rule, which is $167, you can see that, of course, we're down up 26,000. Here we're down up 19,000, 38%. Its NAV is better here. Again, HYLD wins both on ROI and it wins on NAV. Here it's losing on both scenarios. You could also see, because it is the 4% rule, that's what growth investors love, you're never going to likely see the NAV go to zero. It's actually still going up. And that's because the number is so small of the 4% rule. This guy, VSP, will run infinitum if you're happy with a $167 monthly withdrawal. This one does take into account that you don't have to buy as many shares with the dividends, so it does actually calculate the dividends paid and when it does that. So, okay. So now we're going to go to what I looked at as HYLD's maximum stable withdrawal rate, which is $500, way lower than the other guys. But of course, when you only got an ROI or a yield of about 14%, you're not going to get anything better. So let's do 500. And of course, look at what you get. The stable number is 12%. Well, guess what? Not so shocking, because $500 is basically equal to its yield. So what it says is you could pull out its yield. And the NAV is stable, so you're able to do that. So you can see that basically units bought go from 0 to no more than 10, but it never goes below 0. It's going to constantly go up. The other thing you're also going to see is that even though here we're still at $15,000, we're up $15,000, even though it paid its maximum stable rate of $500. And it will be able to do this for a long, long time, years and years and years, because it's basically paying out its yield. That's really what it's doing. Okay, if I look at VSP now, the underlying or the pseudo underlying, similar underlying, it started at 50,000. It's now still at 17%. So after 2 years, it's still above the 50,000 by $8,000, not 15,000, but it's still up by 8,000. So HYLD still wins after 26 months on NAV, and it wins still on ROI because nothing changed there. But what you can see is that by the 8th or the 9th year, VSP will run out of shares. You will not have any more shares to sell. And again, harping on this over and over, why I'm confident in telling you that when you want to talk about maximum income withdrawal efficiency, you're not going to beat a cover call ETF on this, because at the end of the day, VSP does not generate enough dividends or distributions to keep up. So it always will have to withdraw. It will always have to erode from its shares all the time. It lost 131 shares in the first 2 years. It will keep losing shares until to such time it has no more shares to give. And so by the 8th or 9th year, you have done full meltdown on VSP. It was a great little stock, but at the end of the day, this ETF ran out of juice because you asked for $500 a month from it. It couldn't survive that. And again, yeah, you could turn around and say, well, we'll give it only 300. But the point I'm trying to make to you people is the fact that where HYLD is able to support a $500 a month income withdrawal, VSP cannot do it because it does not have the income generation to keep up. Sooner or later, even though it's a great ETF, it will not be able to win in the income race because it can't deal with $500 withdrawals, but HYLD can. So this again hits home. What I'm trying to say is that income portfolios, high yield income portfolios, will always beat a growth portfolio during the consumption stage. So let's go back down to our final guy and let's talk about him. So what we saw was Steady Eddie, HYLD versus VSP. During 0 month withdrawals, even with 0 monthly withdrawals, aka no contribution accumulation, HYLD still beat VSP in the ROI race and in the NAV race. And that's due to HYLD's leverage and monthly distributions outperforming VSP's native S&P growth and very minimal dividends. Due to HYLD's slow growth, house money status is at least 10 years away. I couldn't even give you a house money status. It would take, I'd say, about 10 years because the yield is so small. It's going to take at least about 8 to 10 years for it to do that. Using the growth 4% rule, not much changed. HYLD still wins in NAV and ROI. At a much lower monthly withdrawal, VSP would never melt down to 0. So that's the good news there. You can hold VSP forever and it will always pay your $167. So you'll be safe there. Using HYLD's maximum stable $500 a month withdrawal, though, where it can stay alive and let's see how it goes. HYLD proved that its NAV is still above its initial investment after 26 months without selling any shares, while VSP's NAV only at initial investment after 26 months, and it fully melted down by the 9th year. Give it credit, it did survive 9 years, but it ran out of juice and you fully melted it down after 9 years. HYLD would have kept on going. If you apply the 20% bear market, I forgot to do that, by the way, but I'm just going to tell you what it is here. HYLD's NAV still, of course, is above its initial. It's at its initial market initial price, even with the market decline, and still doing its monthly withdrawal obligations. It's still meeting its $500. The VSP NAV is now below the initial investment after 26 months when I did this 20% bear market, and fully depleted after 7 years, not after 9 years. Again, I should do this because some people are going to watch this video and basically screen save it. So let me just go here and show that to you because I apologize for not showing you. Here is the 20% bear market. You can see that it died after 6 years. On the 7th year, it ran out of money. So let me just freeze this for a second so people can look at this. But this is $500 withdrawal, 20% market bear. And this is the situation where the two kept on going. We were still over the initial NAV for HYLD. We are now under the initial NAV for VSP at a 20% bear market. We are now -7. Okay. There you go. Go back to where I was. Okay. So basically the clear winner on this one is HYLD. In every situation, it is the income investors winning over VSP. So what would I do if I were Perry? If I were an income HYLD investor, again, don't change anything. If you like having this one in your portfolio because, again, you want diversification, HYLD will deliver. It will deliver even up to a 400 or 500. I wouldn't push it to that 500 level, but it can do up to $500 a month in income. Nothing there. You know it's a very stable NAV, so it's doing very good, and it can actually meet its numbers. There's nothing I would change with HYLD. If you were a growth investor with VSP, again, like all the other ones, you can either decide to accept VSP can only support a lower monthly withdrawal than HYLD. It may only support up to $200, $250 versus HYLD can keep giving you safely $400 to $500. So you just have to accept that, okay, so I got VSP and I don't like covered call ETFs, so I'm going to keep holding VSP and just accept the fact that VSP can only pay out $200, not $500. Or, again, take the opportune market timing, start selling some of your VSP stock. The sooner the better, because the more you can get, as you wait longer and longer, you have less unrealized NAV to convert into cash that you can now buy covered call ETFs. So the longer you wait on that decision, the less covered call ETFs you'll have to actually convert to because you're not going to have as much cash. But you should start selling it and then maybe look at stable NAV covered call ETFs like HYLD or others. HYLD is a very low. There are very good covered call ETFs that are paying 15, 18, 20, 25%. And then there's the ultra yielders, as we've also seen. So if you're very diversified, you could look at all of them and start converting your VSP into a cornucopia or a broad spectrum income portfolio, something sort of like mine. I have up to 35 of them, but you could even go and look at other index ones and stuff like that. All right, so let's look at the conclusions. First thing is, in this video, we saw that under all three extreme covered call ETF situation, the Rockstar, the NAV Eroder, and the conservative Steady Eddie, the high yield income strategy always beats a growth strategy during the fire or retire phase of your life. There's no situation unless you really are picking an absolute loser dog. At the end of the day, when you're in the consumption stage of your wealth consumption stage, you're not going to have a growth portfolio that's going to out income generate an income portfolio. You could do it, but you're going to have to either be several times larger than an income portfolio in order to generate the 4% rule so that you can match that of a 12% income, which then the question is, well, even if you're 4 times larger, then why would you tolerate being so inefficient at 4 times the size? Why wouldn't you not use that 4 times the size and generate even more wealth on the income side? Doesn't even make sense. When income versus growth portfolios at the same NAV size are compared, and that's what I'm saying right now. If you're comparing head to head with, let's say, $1 million income portfolio and $1 million growth portfolio, Income portfolios will vastly outperform a growth portfolio in two ways. One, the maximum stable NAV cash flow dollars per thousand. You're going to get more cash flow dollars per thousand out of an income portfolio than you will out of a growth portfolio. And that, when I say maximum stable NAV. So you can't turn around and say, yeah, I can do it, I'll just sell more. But if that's not stable NAV, if you're selling more of your growth portfolio in order to match that of an income portfolio, you're not stable anymore. You're now eroding. So you got to say dollar for dollar, an income portfolio will out cash flow a growth portfolio because it generates income and a growth portfolio doesn't. The second thing is long-term sustainability. Because income's stable growing NAV will always beat growth's meltdown NAV. You're going to have to, if you're in a consumption stage of your life, we've said it 1,000 times, the growth portfolio has no choice, but into one way or another, it's going to have to actually melt down, draw down, deaccumulate. All the advisors, financial advisors have several names for it, but at the end of the day, they're all saying the same thing. When you're in the consumption stage of your life, you basically have a growth portfolio. You have to dissolve your portfolio's NAV so that it can pay income. You don't have to do that with a covered call ETF income portfolio. So let's look at some summary metrics. This is going to be very important. It says it all. Comparing the income portfolio with covered call ETFs versus a growth portfolio that has stocks or just general ETFs. When it comes to monthly cash flow, covered call ETFs it's getting it from monthly distributions, and no units must be sold in order for it to generate your monthly cash flow. In a growth portfolio, you must sell shares to capitalize it in order to have money to withdraw. And there's there's little or no generated income out of growth portfolios. Again, I'm not including dividend stocks. They definitely have an added advantage during the consumption stage, but they still won't compete against a covered call ETF because most dividend stocks can only pay 5 to 7% yields. You're never going to get even the most conservative 12, 14%, as we saw with HYLD, much less the 20, 30%. You just can't compete. Long-term NAV projection, stable and a growing NAV. If you built a good income portfolio like I have with mine with high diversification and 2 to 3 times withdrawal distribution growth, you'll have a stable or growing NAV because you'll be able to reinvest and keep the NAV stable as it's paying you what you need to live during your retire or fire years. An excess distribution source is used, or excess distributions is your source of contributions. It actually does give you your source of contributions, something you cannot do in a growth portfolio because you have no more source of contributions. Since your portfolio does not generate its own little or no, like dividends, but even if it has almost little or no, that's what I should say, you can't contribute to it because you don't have an employment income anymore to put money into it. Because remember, you're no longer accumulating, you're consuming. So you have no way to add money to your portfolio. So your portfolio generally erodes towards zero as you follow your meltdown strategy. Shares remaining. In a covered call ETF, you're increasing due to reinvestment, whereas on a growth stock, you're progressively selling off all your shares and wealth as you keep trying to pay your monthly retirement or fire living expenses. Sustainability. With a covered call ETF or high yield income portfolio, lifetime stable growing NAV. So it will sustain as long as you have a mature, well-diversified covered call ETF strategy and portfolio. Your portfolio will continue to be stable in NAV and or even increasing in NAV while it still pays out its monthly bills so you can live. It has a substantial wealth will also be left for your loved ones. Because if you live 25, 30 years in an income portfolio and you're stabilizing the NAV or even growing it, you've got all your monthly living expenses out of it every month for 25, 30 years. And your NAV is the same way, if not larger than it was when it started. So your loved ones get your principal while you get to live off of the income. So huge, substantial wealth left over for your loved ones. If you're a growth portfolio, you have low sustainability because your portfolio wealth is constantly being eroded. That's why, again, the big professional investment and retirement investment advisors keep on calling it the meltdown strategy or the deaccumulation strategy. That's because let's call it a spade what it is. It's dissolving your portfolio by selling your shares and selling the unrealized capital into capitalized income. Therefore, because you constantly are degrading or dissolving your portfolio, the declining wealth lowers your inheritance for your loved ones. So you might have had $2 million, but by the end of it, you may only have $750,000. Whereas on this one here, you had a lot more because you were actually keeping it where it was. And the part that a lot of growth purists do not grasp is peace of mind. They keep talking about ROI as all it counts. No. There's more to the benefits of a cover call ETF or income portfolio than just ROI. And we showed how even ROI doesn't matter in this case, because when you're doing NAV erosion, it was still eroding, even though your ROI was the same. But let's put the other things in the factor that you don't take into account, and that's the intangibles. First of all, no stress during the long bear markets. And again, I know people say, oh yeah, that's when your portfolio is going to, no, it won't. We saw it on the pandemic. We saw it during Liberation Day. Yeah, it could look scary, but at the end of the day, when you keep seeing your distribution show up every week, and now for me, every day, I turn around and I've gotten used to it. It's like, yeah, okay, so we're down 15, 20%. Yeah, I've seen my NAV drop, $60,000 in one day. I was not even worried. I just basically didn't turn the TV on, didn't open the spreadsheets. You're passive. The only thing you're doing as a cover call ETF for peace of mind, I'm just deciding every month where I'm going to reinvest the excess money that I didn't use for living expenses. I mean, that's like, I want to know where I can go shopping. That's passive. That's all I'm doing. And then the other thing is maybe do some, rebalancing and some reinvesting, but that's it. That's the only thing I have to do on a cover call ETF. I don't have to worry about any complex meltdown strategies. I have to, first I'm going to dissolve all of my TFSA, then I'm going to get rid of some of my RIF, and then I'm going to maybe get rid of my LIF first. And, with a cover call ETF income strategy, none of them are eroding. They're all the same. They're actually growing. So I don't worry about meltdown strategies because I don't have a meltdown strategy. I don't need to. And I'm generating income way beyond my needs. If you're a growth investor, capitalizing during the bear markets is something you're going to be scared of. If you're down 20, 25% and you don't have a cash wedge and you basically don't have idle money sitting there that wasn't generating you anything in the first place, but it's there when the markets are down 25%, you're now going to have to sell extra shares every month in order to live because your markets are down. You need to build complex meltdown strategies. So you're going to have to either do it yourself or work with an advisor to say, okay, Perry, first you're going to have to get rid of the LIF, and then maybe after we dissolve the LIF, we'll move over to the TFSA, and then you're going to have to look at up with the CPP. So these are the things as a growth portfolio investor you have to worry about. And then finally, inheritance to the loved ones eroding. I don't worry about it because I know when I'm done, I'm living off of the income. My portfolio's NAV is still there, if not growing. When you're a growth investor, not only are you basically eroding your wealth for yourself, but you're also watching your wealth erode so that when you pass away, the amount that you give to your loved ones keeps going down as well. So these are all peace of mind factors that aren't taken into account and are totally ignored by one of those growth investor purists. Finally, I told you this was going to be long. I expect arguments from the growth always wins investors that dislike all things cover call ETFs or even income. Some of their arguments are going to be like, Perry, during growth phase, my NAV became much larger. So you can't compare same size NAV like 50 to 50 because I grew faster when I was accumulating. Well, that's fine. But what I'm trying to tell you, and I said in the video earlier, is the fact that you've seen that an income portfolio is far more income generating effective than a growth portfolio. So even if you generated 4 times more NAV than an income portfolio did, why are you sitting there running basically like a 2 mile per gallon car when you could actually move that money and buy yourself something that runs 50 miles to the gallon? So the idea would be is, yeah, fine, you did grow more, but why would you then still sit on a growth portfolio and say, I'm sticking to it and I'm just going to erode it because I can afford to erode it? Makes no sense. Secondly, Perry, I don't have to worry about bear markets. I will use my cash wedge of idle cash reserves when the markets are down. What a wonderful idea. So you think the markets are going to be down 6 months. So you're going to take 6 months of, say, $10,000. So you're going to hold $60,000, $80,000 of cash in idle money market funds that barely, if even, keep up with inflation, as opposed to having it invested where you were actually growing your money on a growth stock like Tesla or Nvidia or whatever. So yeah, that's fine. While you're waiting for the markets to crash, your money is sitting idle doing nothing and you're wasting it. You've taken that money out of your growth. When I've got an income portfolio, all I do is I fully utilize all the money that's running, generate maximum amount of income, which is 2, 3, 4, 5 times my monthly needs. And I could basically keep making my monthly compounded income grow. Therefore, when the markets do crash 20, 30%, I go down, but I don't go down to the number where I can't afford to live anymore. It basically is the buffer is so large because I've reinvested that I don't worry about that. Or you get another argument, but it's not fair using such high monthly withdrawals. It should be 4%. So what you're basically saying is because I can't generate a 20, 30, 50, 70% withdrawal rate that you can't either. So just because you can't do it, why should I not do it? Again, at the end of the day, you're saying that your growth portfolio is as powerful, if not more powerful, than my income portfolio. So if it is, and I can actually run a portfolio that has a 20% withdrawal ratio, then why are you not being able to do it? So that's just a bogus argument. I don't have to come down to your 4% rule. If I want to run my portfolio and successfully grow, even though I'm withdrawing 20% a year out of my portfolio, then you should be able to do it too. If you can't, you got a problem with your portfolio. And Perry, you're assuming that all your covered call ETFs during a long bear market will act just like growth stocks and they'll recover quickly. Yeah, I'm assuming that because you can't assume they won't. What I can tell you is that in the pandemic and in the liberation months that we had just earlier this year, in both scenarios, the covered call ETFs actually fully recovered. They may have not recovered immediately like the next day, but they fully recovered. They still paid their monthly distributions like they did. I did notice that my distributions dropped equal to the down market. So it went down about 18%. My distributions that month went down 18 to 20%. So it went down equal to the drop of the markets. And by the way, it went right back up when Liberation Day ended and the market started skyrocketing. I went up there. So I have evidence that it will recover. You have zero evidence that it won't. And I'm going to see many more of these arguments, and I know I won't convince them. I'm not here to convince them, but please leave your comments below. I know I'm going to get a lot. All right. Finally, I want to point out here that even though this video presented a direct head-to-head ETF versus underlying comparison, as if they were the only holding in the portfolio, let's be real. In reality, a healthy portfolio, income or growth, must be highly diversified. If you don't have a diversified portfolio, you are running a very dangerous game. And with this diversity, my high yield income portfolio spreads the total monthly withdrawals across all my received income from all 35 of my covered call ETFs. So where you saw that HOOY was maxing out at 2,900 and CONY was maxing out at 1,900 and HYLD at 500, that's max. I have 33 or 35 covered call ETFs all generating income. I basically put it into a common bucket. I pay out what I need, and then I reinvest back to which of the covered call ETFs that need money. So the good news about diversifying my portfolio is that I can direct my reinvestments back to the covered call ETFs that need reinvesting back, and the ones that don't need it because they're actually NAV growing or whatever, I don't. So just wanted to point that out. Nowhere should anyone ever build a portfolio with one covered call or one stock. It doesn't matter what it is. Even if it's something like VSP, which is an index, I would still make sure you diversify. Okay. I hope you found this video valuable. I apologize that it's very long, but I knew it was going to be because it's a very complex topic. But I wanted to show why I'm 100% fully confident that my diversified high yield income portfolio is the best option for my fire retire phase of my life. And I know it would be for anyone else that's entering retirement or a fire strategy. So I hope this helps you learn that. If you're a growth investor and you're deciding you're on the fence, you now have this evidence to say, oh, okay, now I can see that this might work. So I don't know if this is going to convince you. I'm not here to convince you. I just want to present you the facts. You make your own decisions, but at the end of the day, I hope it helps you. Also, again, I'm going to ask one more time. This took a lot of work. It took over 3 or 4 days to build this spreadsheet. It took even another day and a half to build the content and the conversation around it. I really would appreciate that you would like this video. If you really liked what you saw, I've got lots of other videos like this. Please subscribe to my channel. I love doing this kind of work, and I really appreciate if you reciprocate with the effort with, slapping of the subscribe button. All right. And until then, stay safe, stay investing, and I'll see you in the Piverse.